One of the most widely respected technical experts out there, senior market strategist at LPL Financial. Ryan, thanks so much for being with us. What's your view currently, Ryan, on what we're seeing when it comes to those US indices? What levels are you watching out for on the Dow, on the S&P? Markets seem to be defying all logic and all fears currently. What's your sense going forward?
Well, we tend to stick specifically with the S&P. You know, it's kind of flirting right there, just jumped back up over the 50-day moving average. I mean, the way we kind of look at things, we don't get too into levels specifically here. We just think, hey, we had a bear market in the fourth quarter, a 25% bounce, approximately, then about a 7% correction in the scary month of May. And we think really we're just kind of going to go sideways here during this summer months with all the headlines we can get into. But what happened? The S&P is about 2,800 approximately, where it was in January of 2018. So really, after a massive rally in 16, 17, the first half of 18, we've just kind of gone sideways for a long time here, and that's kind of the way bull markets work. They can frustrate you, but in our opinion, it's the market's way of kind of catching its breath. And if we get better fundamentals, which we can talk about the second half of the year, which we expect, we wouldn't be shocked at all if the S&P kind of broke out of this range and continue this upward trend here.
What are your thoughts, Ryan, on the current trade tensions? Is it something that you feel, continues to pose a major threat, given that, there's really no clarity on how far we are from a resolution? What's your sense?
It sure seems like the resolution kind of keeps getting kicked further back, doesn't it? I mean, we were in the boat with many people 2 months ago that we were very close to a resolution, and clearly that's not the case. Now, what everyone has circled on the calendar is the G20 in about 2 weeks, and we don't expect a resolution at the G20, but we hopefully are looking for a path to resolution. I mean, S&P is only a couple percent from all-time highs. Various global markets are all-time highs or 52-week highs, so the market's really taken in stride the trade war that's going on, but at the same time, we need some positive news, some positive headline to kind of justify things here. And we are of the opinion that we're probably by fall, we should have some type of pretty good resolution with China and the trade war. Now, that's a ways away, and a lot can happen before then, but we still think the negatives for both sides are just so great that hopefully both sides can get an agreement on it. But again, the U.S. economy specifically is really, it's not doing great, but it isn't doing poorly. 2.5% GDP growth, maybe a little higher, 5% earnings growth this year is what we still expect. That's not spectacular, but it's also better than a recession, right? So we still see some positives out there, even with the negatives on trade war.
So June is turning out to be a long developed markets and a short emerging markets. How would you position yourself for developed markets versus emerging markets for the rest of the year?
Well, we are in the EM camp, and we have been for a while. When we look at emerging markets, just simply look at valuations. Emerging markets are really cheap. Now, historically, emerging markets are cheaper because it's a little more volatile. But when we see some of the cheap valuations there with the potential for positives on the fundamental front, we still think there's more growth. We look at DM, the developed markets, talk about Europe. There's still those underlying fundamental issues, the demographic issues, Brexit. Those Europe and developed markets in general is an area that we haven't really been overweight in the models we run for our LPL advisors for a couple of years now. And we are a little bit overweight emerging markets. And I know, they had the good run, and they pulled back a little bit recently, but we still think there's just more potential for outperformance the remainder of this year with emerging markets. And let's be honest, at the end of the day, it does hinge a lot on the trade war with China. And again, we are still in the camp, though, that we can have potentially a resolution. Let's not forget the U.S. dollar, right? U.S. dollar, we think, will gently go lower the rest of this year as the Fed potentially eases. A lot of people on one side of the boat bullish the U.S. dollar. Markets have a funny way of making the masses usually wrong. So if you get a little bit lower trending dollar, which is our base case, that's another potential tailwind for emerging market potential outperformance the rest of 2019.
What is your preference in terms of order for emerging markets?
Well, when we look at EM, I mean, the way we look at it at LPL Research is we really just play the big ETFs and some of the big mutual funds. We don't quite get down to the company-specific, or I'm sorry, company-specific, country-specific level. But at the same time, when we see things like Argentina breaking out to new all-time highs, relative strength, Brazil's been doing very well. Obviously, India has been doing extremely well. There's the big thing of China and underperformance a little bit recently. But when we see some of these countries under the surface, and look at Greece. I know Greece is not an emerging market country, but Greece quietly is having a really good year with their stock market. If you really think we're going to have a global recession in 2019, which we don't, but if you did, I don't think we'd be seeing those countries break out. Switzerland's making new all-time highs, as we speak. So there's a lot of countries that are doing really well under the surface, and in the emerging markets, some of those specifically, that really make us think that this cycle is going to go on. And if you don't think you're going to have a global recession this year, emerging markets is probably that place you can find some alpha, some outperformance, and that's how we are positioning our models for the rest of 2019 here.
What's the biggest risk then, Ryan, if we had to take one thing? What do you feel is the biggest risk to the market at the moment?
Well, clearly, potentially, you have the trade war. The global slowdown is probably our biggest concern, potential global slowdown. I mean, yes, the United States has had some okay data. Specifically, we were really impressed with some of the big jumps in consumer confidence, small business confidence last month in May. We had 7-month highs in what companies are expecting to use CapEx, capital expenditures, investing in themselves. That's confidence. Companies wouldn't do that if they thought there was a recession coming. But the global picture is still murky, obviously, at best. The way we say it is, we just need Europe to kind of not mess things up here, pull the rest of the globe down with it. And at the same time, Fed policy. And we haven't even talked about the Fed yet. We've been talking for a while. I mean, a potential policy mistake. Everyone's in the camp that, we're going to get at least one rate hike probably in July, maybe even 2 rate hikes if you look at Fed funds futures. So could there be a potential policy mistake there? That's the uncertainty, and you usually don't know that until after the fact, unfortunately. So those are the things we're watching. But what we do know is the U.S. economy, in our opinion, continues to kind of outperform the lowered expectations. Look at earnings season. People thought earnings would be down 5%. They were just up slightly. So continue to beat that lowered bar. And we think that's kind of the play the rest of this year as the economy will probably surprise to the upside, global economy and U.S. economy.
Ryan, Indian equities have underperformed in June, but have also hit fresh lifetime highs. What are the charts suggesting going forward?
Well, in general, our opinion on India, it looks good. Like you said, we've had a little bit of a pullback here, maybe a little bit of a post-hangover after the election potentially. But what really encourages us about the Indian markets when we kind of look under the surface, financials. I mean, financials are a very big part, obviously, of any economy. Financials are leading. You look at what's going on in the U.S., financials really aren't doing all that well. So the financial leadership is really a positive thing in our opinion. And just that big global picture, global backdrop, like I talked about on emerging markets, continued strong GDP growth in India, continued decent earnings. So all in all, we think that bull market that you guys have been in for a while is firmly in play, and the financial leadership's a great thing. Now, I will say one thing that I'm not even sure what the answer is, but small caps, clearly, when I looked at the charts, small caps have really underperformed large caps in India, and the markets are still hanging in there, obviously, very well. So that's kind of got our attention a little bit, but the large cap leadership with the financials hanging in there, bank stocks specifically and financials really leading, those are things that we really, you tend to see in a healthy, strong economy, and markets tend to lead the economy, so flirting with new all-time highs right around there, that's probably a good thing for the economy 6 to 9 months from now in our view.
Which sectors other than banks you would bet on to drive equities higher from here on in India?
Right. Well, I mean, the whole value versus growth thing, right? I mean, on the growth side, you have technology. Technology in India has been doing very well. Technology in the last week and a half here in the United States has really jumped back, and it's one of the largest components, obviously, to the whole globe. Obviously, technology is a very big part of emerging markets as well. So technology is kind of that area that really matters, probably more than most, we think. But at the same time, look at cyclicals versus defensive. Cyclicals, things like industrials, financials, technology. At LPL Research, in about 2 weeks, we're going to release our mid-year outlook, and we are still very bullish on the cyclicals. If you don't think there's going to be a recession, which I've kind of laid out already, those cyclical areas are very important and should continue to do well. Defensive areas like telecom and utilities, we're underweight those areas, and we still think being more offensive, looking to the cyclical leadership to extend. Hey, the U.S. is in a 10-year economic cycle of growth. It just happened, ties the longest record since the 90s. We likely will break that longest streak ever later this summer. So what's it mean? Okay, the economy's old. You have to have a bear market. You have to have a recession right away. We absolutely do not think so. I mean, the economy is just barely growing here in the U.S. at 3%. You know, we're not over the top growth by any means. We think we can continue to muddle through here and see okay growth, not great growth. And then if you have some positives on the trade front, that can bring back confidence, bring back capital expenditures, CapEx, companies investing in themselves, and really increase productivity and extend this old business cycle. But maybe we can have a couple more years left of business growth here in the U.S. at least. And that's our base case view.
Ryan, thanks so much for taking out time for us. Always good to get perspective from you.